stock market or real estate? Which one builds wealth faster, safer, and smarter? People love to argue over which is better, but the real answer is more complex and more personal. Some investors swear by the hands-off power of index funds. Others won't touch anything but rental properties. When you invest in stocks, you're buying ownership in a business. Whether it's Apple, Amazon, or a basket of companies through an ETF, you're betting that these companies will grow and profit over time. Stocks are paper assets. They exist digitally and are traded on markets like the New York Stock Exchange or NASDAQ. On the other hand, real estate is a physical asset. You're buying land, buildings, or property that people live in, rent, or use commercially. Your returns come from rent, appreciation, and leverage. With stocks, you're riding the economy. With real estate, you're managing a piece of it. Both represent ownership, but in totally different ways. Anyone with a smartphone and internet can start investing in stocks today. Brokerage accounts are free, sign-up takes minutes, and with fractional shares, you can invest as little as $1. You don't need a lawyer, a realtor, or a loan officer. Real estate, in contrast, requires much more setup. You'll need thousands in down payments, good credit, inspections, legal documents, and possibly months of searching. Plus, once you buy property, it comes with upkeep, tenants, and sometimes headaches. If you're looking for an easy on-ramp into investing, the stock market is your express lane. You can start with $10 in stocks and be instantly diversified. Real estate? You're looking at thousands, often tens of thousands, just to get in the game. Even with a mortgage, a 20% down payment on a $250,000 home is $50,000, plus closing costs, repairs, and reserves. Stocks are far more beginner-friendly financially. That doesn't mean real estate is worse. It just means you need more capital and credit to begin. If you're just starting out or your savings are limited, the market offers an affordable way to start growing your money now. Over the long term, the stock market has averaged 7 to 10% annually. That includes bull markets, crashes, recessions, and recoveries. If you invest consistently and reinvest your dividends, you can double your money every 7 to 10 years. Real estate may offer lower appreciation, 3 to 5%, but it makes up for it with leverage and cash flow. A 5% gain on a $300,000 home where you only invested $60,000 out of pocket could yield a 25% plus return. Plus, rental income gives monthly profits, tax benefits, and forced appreciation through renovations. Real estate can outperform, but it takes work, debt, and management. Stocks are more passive, but also powerful. The stock market is highly liquid. If you need to sell, it takes seconds. Just click a button. Real estate, however, can take weeks or months to offload, and it usually comes with fees, agent commissions, repairs, staging, and taxes. If you're ever in a bind and need cash fast, stocks give you speed and flexibility. Real estate gives you stability and control, but not easy exits. Liquidity is underrated until you need it. Stocks win here. Stocks require almost zero day-to-day maintenance. You can automate your investments, check your portfolio monthly, and still build wealth. Real estate, on the other hand, demands effort. From dealing with tenants, maintenance, property taxes, and unexpected emergencies, it becomes a part-time job, or even a full-time business. Even with a property manager, you're still responsible. If you love being hands-on and enjoy real assets, that might be a plus. But if your goal is passive income with low effort, the market is a better fit. One of the biggest advantages real estate offers is leverage. You can control a $300,000 asset with a $60,000 investment thanks to bank financing. That means your returns are multiplied. If property values rise just 5%, your return on cash invested could be 25% or more. In stocks, you can also use leverage through margin accounts, but they are far riskier and can trigger margin calls. Real estate debt is stable, long-term, and often fixed rate. If you use it wisely, leverage makes real estate incredibly powerful. Real estate can put cash in your pocket each month through rental income. This cash flow can cover your mortgage, build savings, or be reinvested. Stocks typically offer returns through capital gains and dividends, but unless you're investing large amounts, dividend income tends to be modest. If you want your investments to pay you regularly, real estate might be more attractive. If you're focused on growing wealth passively over time, stocks can deliver consistent, reinvested growth without the hands-on work. Both investments have tax advantages, but real estate has more layers. You can write off mortgage interest, depreciation, maintenance, and travel. You can defer taxes with a 1031 exchange. In some cases, you can avoid capital gains entirely. Stocks benefit when held in tax-advantaged accounts like IRAs or 401ks, and long-term capital gains are taxed at lower rates. But real estate investors have more flexibility and control over how and when they pay taxes. With the right strategy, some real estate investors pay no taxes at all. Stock market volatility is fast, loud, and daily. Prices can drop 10% in a week, and news headlines can cause panic. But historically, the market always recovers, and downturns are often great buying opportunities. Real estate, on the other hand, is more stable, but not immune to risk. Housing markets can crash too, as we saw in 2008. And risks like bad tenants, vacancies, lawsuits, or natural disasters can wreck your cash flow. With stocks, the risk is market-driven and emotional. With real estate, it's operational and situational. The kind of risk you're comfortable with often determines which investment feels safer to you. In the stock market, you're a passenger. You can choose the company or fund, but you can't influence how it performs. In real estate, you're the driver. You can upgrade the property, raise rent, negotiate deals, or refinance to improve your returns. You can even choose to rent, flip, or hold depending on your strategy. That control means more work, but also more potential for creativity and active wealth building. If you enjoy being hands-on and maximizing value, real estate gives you that power. Stocks are more passive but also stress-free in comparison. Building a diversified stock portfolio is incredibly simple. With one ETF, you can own shares in thousands of companies across countries and industries. You can diversify by sector, market cap, geography, and even asset class through REITs, bonds, and commodities. In real estate, diversification takes serious capital. You'll need to purchase properties in different areas to reduce risk. That's time-consuming and expensive. While both can be diversified, stocks make it fast, affordable, and automatic, especially for beginners. Real estate has long been praised as an inflation hedge. As the cost of living rises, rents go up, and replacement costs rise, which increases property values. Your debt stays fixed, but your income increases. That's a win. Stocks, especially companies with strong pricing power, also perform well during inflation. Businesses raise prices, revenues go up, and so do stock prices. However, high inflation usually brings market volatility. In real estate, the effect is slower and more steady. Both offer protection, but real estate tends to feel more secure during inflationary cycles, especially with rental income. Real estate feels real. You can see it, touch it, and walk through it. That tangibility provides comfort for many investors. Stocks, on the other hand, are just numbers on a screen, volatile, abstract, and disconnected from daily life. But that comfort with real estate can lead to emotional decisions, like overpaying for a nice house or being too afraid to sell. Smart investors understand that both asset classes require discipline, patience, and data, not emotion. But psychology matters. Some people just sleep better owning property. Others enjoy the simplicity of stocks. Your mental wiring plays a bigger role than you think. Truthfully, it depends on you. If you want control, cash flow, leverage, and are willing to manage people and property, real estate is a powerful builder of wealth. If you want passive growth, easy diversification, low fees, and flexibility, the stock market is an incredible wealth machine. The smartest investors often use both stocks for passive growth and liquidity, and real estate for income and tax strategies. You don't have to choose sides. You just have to choose what fits your life, your personality, and your financial goals. It's not stocks versus real estate. It's you versus inaction. Stocks or real estate. It's not a competition. It's a question of alignment. What kind of life do you want? What kind of investor do you want to be? Start with what you understand, grow with what you learn, and diversify as you earn. Because smart investing isn't about picking sides. It's about building a future you control. Like, share, and subscribe if you're serious about growing wealth the smart way on your terms.